Hello, this video is all about the adjusting and closing entries, and this is our final set of visual notes for a service business organized as a proprietorship. In these notes, we will go over adjusting entries, types of accounts, closing entries, and the post-closing trial balance. Let's get started on pages 1 and 2 with adjusting entries. We start out page 1 with two accounting concepts. The first is the accounting period cycle, and this is changes in financial information are reported for a specific period of time in the form of financial statements. Next, we have adequate disclosure, and this means that financial statements contain all the information necessary to understand a business's financial condition. So adjustments are planned on the accounting worksheet, but they also need to be recorded. So how is this done? Well, we have to journalize them and post them to the ledger. And we do that with adjusting entries. Journal entries recorded to update general ledger accounts at the end of a fiscal period are defined as adjusting entries. And just as a reminder that all of these steps are linked together. So you'll see down here at the bottom, we first plan the adjustments on the worksheet. Then we use the worksheet to journalize adjusting and closing entries. And then we use the journal to post to the ledger. And lastly, we use the ledger to do the post-closing trial balance. On this page, you'll see that we have a portion of the accounting worksheet. And if needed, you can go back and watch the video that relates to the accounting worksheet visual notes. But hopefully you remember that we've got supplies and supplies expense. The supplies expense when we did adjustments is the debit and supplies is the credit. And so we're going to use the worksheet to journalize adjusting and closing entries. And so we're just going to use this information and make a journal entry about it. So our T accounts are there if needed. We have, again, supplies is the credit because supplies is an asset that's decreasing, and supplies expense falls under owner's equity. And remember, every time owner's equity is frowning, meaning if the business is not happy about whatever that situation is, then it's going to be a debit. So you'll see supplies expense, we've got our frown face, and that makes sense because if our supplies is a credit, then our supplies expense has to be a debit. So when you go to journalize the adjusting entries, you need to start with the heading, and you can see that there in purple. You center in the account title column the words adjusting entries, and then because it's the first one on the page, we do April 30th, so we fill in the date, and we do our supplies expense against the line because that is first, that's the debit. We fill in our $50 there, and then on the second line of the entry, we indent and we write our credited account, which is supplies. And then over in the credit column, we put our $50 there as well. At this point, go ahead and pause the video and fill in the adjusting entries for insurance. Okay, so our T accounts would look like this. We have a decrease in the asset prepaid insurance. And again, the business is frowning. So under owner's equity, we've got a debit of $100 under insurance expense. And you'll see down in the general journal, we've got our date. It's understood that it's April. Insurance expense, again, is debited for $100. Prepaid insurance is credited for $100. Did you get it? Moving on to page 3, this is all about types of accounts. There are two types of accounts. We have permanent accounts on the left, and these are accounts used to accumulate information from one fiscal period to the next. So this includes balance sheet accounts, except for owner drawing. And the idea here is that the ending balances are beginning balances for the next fiscal period. The easiest example to think about is cash. Just because you move from one fiscal period to the next, your cash balance does not go to zero. Think about a checking account balance. If you have $1,000 and then the next month comes up or the next quarter comes up for the next fiscal period, your cash does not automatically go to zero. It makes sense to maintain that account balance. And that's the case for all permanent accounts. On the right, we have temporary accounts, and these show changes in the owner's capital for a single fiscal period. This includes income statement accounts and the account title income summary and owner drawing. Now, what happens here is the balances are transferred to the owner's capital account using an equal opposite entry. So for example, owner drawing, the business is frowning, it's under owner's equity. We know that owner drawing falls as a debit. So the debit then becomes a credit to the temporary account so that owner drawing ends up at a zero balance. These accounts, these temporary accounts, always begin a fiscal period with a balance of zero. Now, that income summary account that's been popping up that we haven't talked much about yet is a temporary account used to summarize the closing entries. It does not have a normal balance. It just accepts all of the equal opposite entries for those temporary accounts. And so if there is a net income, it ends up being a credit. If there is a net loss, it ends up being a debit. And lastly, we have our accounting concept matching revenue with expenses. So again, revenue from business activities and the expenses associated with earning that revenue are recorded in the same accounting period. So that again goes along with our temporary accounts. They need to be zeroed out at the end of the fiscal period. Here we are at pages 4 and 5. This is about closing entries. So as we learned on the previous page that permanent accounts are not closed, those balances carry over from fiscal period to fiscal period. But temporary accounts are closed. And so this page is all about recording closing entries. To close entries, the first step is to close income statement accounts with credit balances, then to close them with debit balances, then to record net income or net loss, and lastly, close owner drawing. So we're going to start with closing income statement accounts with credit balances, and that would be sales. And so let's see the worksheet down at the bottom. You can see that we're going to use the worksheet to journalize adjusting and closing entries. And so we'll follow each one of these T accounts into our journal on the following page. So what you'll see here in our section of the worksheet is we have income summary surrounded by purple with the star there. And then our income statement account with credit balance, that's the sales account. So you can see if you follow the red arrow, our sales is a credit to income statement. So back up to the T account. Sales is a credit. So to close it, we're going to make that same amount a debit. So sales is a debit of $800 to close it. And then that income summary account, remember, is all about just accepting the closing entries so that it can be transferred into the capital account at the end. So we've got income summary then is the matching credit to the debit that closes sales. Next up, we have the income statement accounts with debit balances, and this is number 2. So we've got insurance expense, rent expense, and supplies expense. And you can see the dollar amounts in the debit columns of our worksheet there. So back up to our T account. You can see our expenses, they were all debit balances. So to close them out, we need to do those equal amounts as credits. And then that income summary account, again, accepts that as the matching debit to all those credits. And you can see the 100 plus 600 plus 50 is the 750 total. Okay, number 3 is to record net income or loss. You can see in our worksheet here, it is a net income recorded of $50, and it is in the debit column of the income statement section of the worksheet. And so to close that out, back up to our T accounts, you'll see that it is a credit. So it's a debit on the worksheet. You're going to close it out. It's a credit in the closing entries. And one more time, that income summary accepts the matching debit to the now credit for capital. And I think it's important to note here that it is the capital account that accepts the net income or loss. So take note of that it is owner capital when you're recording net income or loss. And lastly, we close owner's drawing. So you'll see on our worksheet that owner drawing is a debit in the balance sheet section of $100. And so to close that $100 out, we need to make it a credit. And so our T account, the number 4 up there, you've got owner drawing, which is now a credit of $100. And our owner capital account is what we use to record the matching debit. So pay attention to where the capital account is used versus income summary. Okay, so now we're going to record our closing entries in the general journal. And you'll see that we're now on page 3 of the journal and we're on the 6th row. So we are doing this after our adjusting entries, But similarly, we are going to center the account title. So now we have closing entries centered as our heading in our journal here. And we're just going to use those T accounts that we did on the previous page. So first up, we have a debit of sales and a credit to income summary. And it is journalized like this. We just need the date. And then we do a debit of sales for 800 and a credit to income summary for 800. Next, we record our expense accounts. And so again, if you look at our T accounts, it is a debit to income summary and a credit to each one of those expense accounts. Now, if you remember from when we talked about petty cash, when you have multiple accounts that equal a single debit, as we do here, you can separate out those credit accounts and just make the one debit entry the total of all of those credits. Our third closing entry is recording net income or loss. You'll see that we have a debit to income summary, and the credit here, this is recording net income. The credit here goes to owner capital. If it were net loss, these would be flip-flopped. The capital account would be the debit and the income summary would be the credit. And you just use the worksheet to guide you. So because our net income was a debit in our worksheet, it is a credit to capital here and vice versa. Our fourth and final entry is closing owner's drawing. So we have a debit to capital that matches the credit to drawing, and the drawing is normally recorded in the debit side. So to close it, again, it's the credit. Hopefully all these color-coded accounts help you understand what's going on here. Down at the bottom of this page, remember all of these steps are interconnected. So we're going to use the journal to post to the ledger. And you'll see the first example for supplies is entered here. We've got our supplies account. It is from General Journal page 3. It is a credit of $50. And so then it adjusts our account balance, as you see here, to $1,050. Similarly, for prepaid insurance, again, it's the 30th. It's still General Journal page 3. In our journal, our prepaid insurance is a credit of $100, and you'll see that we're recording it as a credit to $100 in our ledger. And again, that adjusts our balance. So now our balance is $500. So if you need a review for that, you can go check out the video for posting from the General Journal to the General Ledger. And lastly, we're going to use this ledger information to do the post-closing trial balance on the next page. Our sixth and final page goes over the post-closing trial balance. Recording the post-closing trial balance starts with a heading. And so we have our business name at the top and then the name of what the document is, which again is post-closing trial balance. And then we have the date on which it was completed, and that is the heading. Then we have an account title section, and we just copy over all of those permanent accounts. So we've got cash, accounts receivable, supplies, prepaid insurance, accounts payable, and our capital account. And then you just record the debit or credit as they are. However the balances are, you take that from the general ledger, and then you add them up, add each column up. So the debit column total is $2,250. The credit column total is also $2,250. You want to make sure that they match. You're one last time checking to make sure debits equal credits. And when they do, that is a good sign. And then you start the accounting cycle all over. So in the next fiscal period, you begin with analyzing transactions using your source documents. Then you journalize and post to the ledger. Then you prepare the worksheet, and from the worksheet, you prepare the financial statements. And then from the worksheet, again, you journalize and post adjusting and closing entries. And one last time, you check that debits and credits are in fact equal with the post-closing trial balance. And then you just start it over each time a new fiscal period comes around. At this point, you can go back through your notes and add any other colors or notes in the margins. I hope you found this helpful, and thanks for watching.